Thank you, George, for the introduction. Let me begin by thanking the organizers of the Global Ethical Finance Initiative for inviting me to share my thoughts with today's global audience. Before I begin my talk, I must also acknowledge the enlightening and very informative discussions by the preceding speakers on financing the Sustainable Development Goals. I hope many of you take away from these discussions an enriching and innovative set of ideas and are also able to turn them into action. Now, the overarching theme of this summit stresses some of the key developments that are taking place at a global level and reshaping the financial services industry and its role in the economy. As we are all aware, as an aftermath of the global financial crisis, it has been recognized that the financial system must not only be sound and stable, but also based on ethical, sustainable, and responsible principles. The general understanding is also steadily evolving. The central banks should support sustainable finance as part of their efforts to advance the sustainability agenda and to integrate such considerations into their policy framework. It is encouraging to note that the central banks globally are increasingly embedding ESG objectives into their mandate and mainstream activities. For my remarks, I was asked to speak about the S in ESG and why it matters. As a central banker, I will therefore talk about the social considerations for a central bank, particularly, and will illustrate how the State Bank of Pakistan, Pakistan Central Bank, is contributing towards a better society through incorporating social dimensions in its mandate. To this effect, I will first speak in general about how global thinking amongst policymakers is evolving about the appropriate role and mandate for central banks and the extent to which central banks should pay attention to social dimensions. And second, I will illustrate from the experience in Pakistan how Pakistan's central bank, the State Bank of Pakistan, has endeavored to give special attention to the social aspect in its policies and especially during the response to COVID. So let me begin by talking a little bit about how the thinking about central banks' role and mandate is evolving, particularly in the context of social issues. Traditionally, I'm talking about, say, 20 years ago, the view of central banking was that it should remain confined to the core areas of price and financial stability, and that it should remain confined to using these traditional instruments such as interest rates, exchange rates, and the regulatory and supervisory framework to achieve these goals. The global financial crisis that started after the collapse of Lehman Brothers in 2007 started a wave of a widening of the toolkit of central banks. And as some of you may recall, it was the first truly global occasion when central banks, and especially advanced economy central banks, widened their arsenal of tools and especially used quantitative easing to try to give an effective response to the global financial crisis. So that was a widening already in the tools that central banks use. But concurrent with the developments since that crisis was the debate that emerged, particularly in the Western economies, about the need to pay attention to inequality, and a debate about whether the growing economic pie, whether the benefits of the growing economic pie were being shared with some sense of proportionality across the different income quintiles. Now, while these developments were already going on about the widening of the toolkit of central banks, the growing awareness amongst policymakers of the need to pay attention to income inequality, on top of all these developments, we were struck by COVID. And the response then that central banks had to give to COVID accentuated this debate. Not only did central banks use more of the quantitative targeting and quantitative tools in general that were available to them, but central banks also had to think about the social issues in designing the policy response to the economic catastrophe caused by COVID. As has been well documented, the COVID pandemic accentuated inequalities, whether in the health or economic dimensions, across countries and also within countries. It has at the same time become incumbent upon policymakers, whether fiscal, monetary, or other policymakers, to give due attention to these social factors. I expect this trend to continue and for the debate amongst policy circles to continue to enrich itself to define the appropriate role for central banks in these areas. I think one thing has become clear, that central banks cannot afford to ignore the social dimension of the policies that are undertaken. Now, this was the first few thoughts that I wanted to share about how the global thinking about the role and mandate of central banks in the S in ESG is evolving. I want to now make this a bit concrete and talk a little bit about how the State Bank of Pakistan has endeavored to reflect social considerations in its actions. Now, our thinking at the State Bank starts with the recognition that the financial sector can serve as a conduit towards equitable access to opportunities. An inclusive financial system can therefore help derive immense social value in a society and lead to improved parity across different strata. Therefore, as a part of the strategic objectives of the State Bank of Pakistan, we have the strategic objective to promote inclusive economic growth in the country. And to this end, the State Bank of Pakistan adopted a 5-year comprehensive National Financial Inclusion Strategy 2023. Under this strategy, we prioritized areas such as branchless banking. Branchless banking is where we promulgated regulations and gave a framework where branchless banking agents can bring banking to those areas where it was not accessible before. Similarly, in the National Financial Inclusion Strategy 2023, we had other important initiatives such as digital payment systems and allocating targets to enhance financing to agriculture, SME, small and medium enterprises, and low-cost housing finance, while also promoting Islamic finance and reducing the gender gap in financial inclusion. Amongst all of these areas that are in the strategic objectives of the State Bank of Pakistan, let me emphasize one area that I believe has particular relevance from a social dimension. And this is the area about helping people, particularly those who are not well off, to realize their dream of owning a house. In Pakistan, over successive years, over successive decades, market failures and other factors have led to a lack of inclusive housing development. And today, we are faced with a gap that is estimated of more than 10 million housing units. Addressing this gap and facilitating financing through mortgages has the promise not only to help people realize their dream of owning a house, but also has tremendous spillover economic benefits by promoting employment in the housing and construction sector, which draws large employment, particularly in the informal sector. To this effect, and as part of the government's vision to promote housing, the State Bank of Pakistan launched a comprehensive dialogue with banks and other stakeholders to address the market failures in this area. Amongst other areas, the State Bank has also allocated mandatory targets to banks to extend mortgage finance and to extend financing to developers and builders. Banks have been required to increase their housing and construction loan portfolios to at least 5% of their private sector advances by December 2021. I'm glad to share that after this intervention, banks' housing and construction portfolios increased by 37% over the last 9 months and have reached $1.3 billion. Before this intervention, total housing and construction finance had remained stagnant for decades in Pakistan. The State Bank of Pakistan, in coordination with the government, is also implementing a plan that whereby the government provides a subsidy in the cost of borrowing for low-cost housing. Under this facility, subsidized financing for the construction of houses or purchase of already built houses is being provided to individuals who currently don't own a house. This is an area that is happening for the first time in Pakistan. And because it's a new area, at the beginning, the emphasis that we have placed, working in partnership with banks, is to put in place a framework as well as targets that will allow the financial sector to play its part in helping people realize their dream of owning and living in their own house. We remain very committed to this goal, and over the coming months look forward to making it possible for those who are not well off in Pakistan to own their own house. In addition to housing, the State Bank has also direct programs to promote access of finance to other sectors which have been left out due to market failures. And in particular, I want to point out three areas where we have ongoing interventions: SMEs, agriculture, and access to finance for women. I will not have space today to go into each of these areas, but I do encourage the viewers and the participants to today's event to look at the website of the State Bank of Pakistan. Just type it in Google and you can find it, and to get information about our various financial inclusion initiatives in these areas. Now, I want to transition from talking about in general the programs that the State Bank of Pakistan has to give attention to the S in ESG through financial inclusion, to talk specifically about how the State Bank of Pakistan endeavored to prioritize social considerations in its response to the COVID crisis. Now, when the COVID crisis struck in February, March of last year, like other central banks, the State Bank of Pakistan also reduced its policy interest rate from 13.25 to 7%. It was one of the largest cuts across emerging markets. Like other central banks, we also used quantitative measures to try to stimulate investment. These effects have begun to show a turnaround in the economy, and the revised growth for this year in Pakistan is projected to be about 4%. But today, I would like to talk about the social dimension of three particular interventions that the central bank made during the COVID crisis. The first was a program for a voluntary deferment of the principal and interest payments on loans and their restructuring. When the COVID crisis struck, it was first and foremost a crisis of liquidity, whereby we thought that for a temporary basis, some people might be unemployed and some businesses might not get their regular volume of sales. To try to ensure that liquidity problems don't lead to solvency problems, whether at an individual level or at a business level, the State Bank of Pakistan worked with the Pakistan Banks Association to implement a voluntary program to defer repayment of principal amounts on loans by up to 1 year, and to encourage the rescheduling and restructuring of the interest component of the loans where the borrower was interested. These programs were voluntary in the sense that a borrower had to apply for it and the decision rested with the bank. But as a regulator, we used our moral suasion, as well as we collected weekly data to ensure that the presumption would be to extend the loans unless there were good reasons not to do so. In any crisis, banks typically become very risk averse, and as a regulator, we were concerned that if they remain highly risk averse and become more risk averse, then even solvent clients may not get this deferment and may become insolvent due to their liquidity problems. I'm glad to say that through this scheme, banks approved about $5.8 billion worth of deferment and rescheduling for 1.8 million borrowers. But here is the crux of the social dimension of this intervention, which is that 95% of the borrowers availing this deferment and loan restructuring facility were individuals and borrowers from microfinance banks. Microfinance banks typically cater to those who are not as well off in society. And so 95% of the beneficiaries of this intervention supported those who were not as well off and in the lower strata of the society. And this, we believe, helped many individuals avoiding bankruptcy by providing them with liquidity if temporarily they had lost a job due to the COVID crisis. So that was example number one, where the central bank prioritized the social dimension in its intervention during COVID. Example number two is a program called a payroll financing scheme. In Urdu, the word is rozgar, which means employment, whereby the state bank explicitly targeted the goal of preventing layoffs. It's one thing in general for a central bank to pump liquidity where the benefits might accrue to the owners of businesses who may, in the end, nevertheless still go ahead and do layoffs. But we designed a program where any business could get a concessional working capital loan from a bank, a loan that was underwritten by the central bank and where the liquidity was provided by the central bank. However, the key condition to get this concessional working capital was that the borrower had to commit that it would not lay off any worker for 6 months. I'm happy to share with you today that due to this intervention, more than 1.8 million jobs of about 3,300 businesses were saved, and a total amount of $1.4 billion was disbursed to pay salaries for such employees, and this was underwritten by the State Bank of Pakistan. And here again is the crux on the social dimension of this intervention, that not only was this a direct intervention targeted to prevent layoffs, but more than 70% of the borrowers availing this $1.4 billion of working capital were SMEs, that is small and medium enterprises. The third example that I wish to share about the State Bank's intervention during COVID that had a social dimension was a direct concessional loan facility for the health sector to support its ability to fight the COVID pandemic and in general to support the provision of good health care in Pakistan. State Bank introduced a refinance facility, that is an on-lending facility, whereby hospitals and other health facilities could use concessional finance to purchase COVID fighting equipment such as ventilators, hospital beds, testing kits, protective gowns, masks, and other such equipment for combating the COVID pandemic and for hospitals to enhance their ability to provide medical care to the people of Pakistan. Under this scheme, about $80 million have been approved for strengthening the provision of health services in Pakistan, particularly to fight COVID. So these were three examples I wanted to bring to your attention about how the State Bank of Pakistan tried to give priority to the S in ESG. And to summarize, the 3 points that I wish to convey in my remarks were: number one, that the thinking about the role of central banks of the social dimension in policy making is evolving, and I believe evolving in the right direction. There is no choice but for policymakers, including central banks, to pay increasing attention to these issues. Number two, to share with you that the State Bank has been espousing these goals through its strategic plan and through several of its ongoing initiatives, including the initiatives to promote housing and access to finance for SMEs, agriculture, and women. And finally, I had wanted to illustrate through some specific examples about how the State Bank of Pakistan tried to keep the social dimension at the forefront in its interventions and support measures during the COVID pandemic. In the end, I would very much like to thank all of you for being here today, for your valuable time. I'm sure the Ethical Finance Summit 2021 will present us with lots of new ideas and thoughts to overcome the current challenges that we face and to make new leaps of growth towards a sustainable future. Thank you.